Take a look at shares of Manulife. If we close at these levels, it will be a fresh all-time high, something we haven't been able to say since before the financial crisis, October 31st, 2007 to be exact. Today's rally comes on the back of earnings that were better than expected, driven by strength in Asia as well as strong growth in its wealth management business. For more, let's bring in Colin Simpson, Chief Financial Officer at Manulife. Colin, thanks so much for joining us. I mentioned the long history of Manulife going back to before the financial crisis, but let's just take stock of the quarter and talk to me about what worked this quarter.
It's good to see you again, Amber. So this quarter, really, a large part of the success is driven out of our asset management business. Really blowout earnings there, 39% up. But not to be eclipsed, we had Asia up 17%. But, Manulife is such a diversified company today that we also had the strength in Canada also translated to great earnings stability. And not only were our earnings ahead of forecast, but also our book value grew by 9% and 14% on an adjusted basis. And that was ahead of analysts' expectations. So, we're really pleased with the progress that we've made since 2017, really, where we embarked on this transformation journey, and particularly pleased with this quarter's results.
Let's talk about that transformation. How is the Manulife of today different from what it was? I'm using that reference point of 2007, but I understand the transformation really took hold at around 2017.
So some people say it's unrecognizable. I think since 2017, and the direction of travel is really towards a lower risk, higher return business. And it may sound quite simple, but when you're dealing with long tail liabilities, it takes some time to reduce some of that risk. And particularly when you've got big macro events like COVID happening at the same time. But needless to say, I think the progress that we've made on offloading or reinsuring liabilities to reduce some of our exposure to that legacy business that has pulled our returns down, as well as accelerating growth in our asset management and Asian business, has really allowed us to push up our return. And our return on equity is really what we're driving for. We said at our Investor Day in Asia this year that we're going for an 18% plus return on equity. This quarter, we did 16.6%. So some reasonable progress early on. But really, I think as we get to that 18% mark, people will recognize us for the high quality company that we are.
One of the catalysts over the last couple of years has been, to your point, reinsuring that long-term care business. So moving it off of from Manulife. There are a couple of opportunities to do that still within Manulife, as I understand. Any update on where those deals stand or when we might get an announcement?
So portfolio optimization remains one of our key strategic objectives. We believe we've got a fantastic portfolio with reserves that are current, and that's recognized by reinsurers. And reinsurers want to transact with us. They want the quality of our business, and they want to deal with the team that we have on the ground because they trust us. So we believe that there's more reinsurance transactions to happen. As and when they happen, that's definitely not for today's conversation. But we're still very focused on portfolio optimization.
I was going to try that. So I did. Let's move on. You mentioned Asian growth, and that was really stunning this quarter. And a lot of analysts are wondering about the sustainability of that. And I asked that in the context of, a Trump presidency, there's a lot of uncertainty around China, tariffs there, how that might curb growth, not only in China, but perhaps in the Asian region. How do you, as a C-suite executive, think about those dynamics, and what has been a big growth market for Manulife?
I think, it's natural for the analyst to ask that question, and I'll step back and use the diversification comment again. We are diversified, and any particular region can have a good quarter at any particular time. And this quarter, we did see strong growth in Asia, and particularly Hong Kong and Japan. Some time ago, maybe the Canadian growth was way stronger, and different parts of Asia. So we're very pleased with the Hong Kong and Japan growth this quarter as it relates to what could happen in the US and impact with trade between Hong Kong and China and the US. We sell peace of mind, and so the products that we sell generally do well in many different environments, and so we're not spending a lot of time agonizing over the outlook for tariffs and trade.
And maybe it's not apples to apples comparison, but Trump was president before and he had a similar stance on China before. Are there any historicals that we can draw on in terms of how the Asian business fared?
No, you know what? There's nothing that we glean from his last term that makes us change anything about how we're carrying out our business today and going forward.
Let's talk about the environment that we find ourselves in, just a general easing cycle globally, interest rate sensitivity, all obviously important for any insurance company, though I imagine that as part of this turnaround, and you've mentioned it before, you're trying to move towards less interest rate sensitivity.
That's right. As a general principle, we don't take big interest rate bets on our balance sheet, and I think when you look at the moves that we've seen over the last couple of days, that's wise. We expect the Fed to cut today, but movements in the short end of the curve don't have an overwhelming impact on our balance sheet. Actually, movements in the long end of the curve don't really have an overwhelming impact because of the way we hedge. But generally, when the long end of the curve goes up, that's helpful for life insurance companies, and we're seeing some good activity in the long end of the curve. And in the short end, sometimes we benefit from, in some areas, we benefit from a lower short end. Parts of our asset portfolio, the infrastructure assets do really well. Some of the funds under management, the fixed income funds under management in our asset management business do really well. So we feel really comfortable with the direction of travel with the interest rates, and particularly as the long end of the curve is staying up.
Wealth management was a key area of growth. And talk to me about what the driver was. It's just a function of, bullish markets are bullish for asset management.
We've seen a bit of that, actually. Our retail business did fantastically well, and that's a sign of higher equity markets drawing in investors. On top of that, we did a platform conversion in Canada, and so we've been really active in recruiting advisors to our Canadian platform. So that's helped some of the growth. But if I look back at if I look at our institutional business, that's also doing really well. And generally because we're very globally diversified, and so in some instances, Asia picks up the slack for other parts, but this quarter, Canada was actually quite strong.
On the conference call, you were asked about M&A, and executives mentioned that that's something that you would be open to. You certainly have the balance sheet, the flexibility to do that. Any insight onto what areas seem more attractive, either parts of the business that you could bulk up on through M&A, or what geographies?
So we've been reasonably active in M&A. If I think about some of the recent transactions, we acquired an asset manager called CQS in the UK last year. We bought out the minority interests of our Chinese fund manager. We bought out them, we made an acquisition in India. So we will continue to look at ways to grow through active M&A. Now, the beauty of our position is we have the capital and we've got the flexibility with our leverage and definitely the balance sheet. But the challenge is when we look at our portfolio, there's no real gaps. We've got a really attractively diversified portfolio that is proving itself to do well in many different environments. So there's no glaring holes that we're looking to plug with M&A, but we'll continue to look at opportunities as they fall due, and we definitely have the balance sheet to pursue them.
All right, we got a